But based on the present run rate, it looks like we're going to get to a situation where the interest alone will exceed the totality of their tax receipts. So where's the money to spend on anything else? They borrow it, of course. They borrow it faster and faster. And that's a debt spiral. It's a bit like if you have a credit card and your outgoings on the credit card are getting more and more. You have to run around faster and faster from bank to bank, taking out new credit cards to pay off the old ones. And eventually the whole thing collapses because the banks lose confidence in you and say, we won't lend you any more.
Friday, June 28th, 2024, Monaco 64, home of alternative economics and contrarian views. Good morning, Clive. How are you?
Hello, good morning, Mario. Nice to see you.
Yeah, nice to see you again as well. And today we're going to talk about the debt situation, the debt spiral, not just in the US, but the whole of the West, because we're going to be affected elsewhere.
So back in 2008, we had the global financial crisis. A lot of people now talk about it as the GFC, global financial crisis. And the central banks at the time decided it was a good idea, all the central banks, the governments decided it was a good idea to bail out via the central banks all their banking system. So there was a lot of money printed by the central banks to do that. And the balance sheet of all the central banks expanded, as did the level of government debt at the time. And one of the interesting things that happened, or which that people feared would happen but didn't happen, was there was no inflation, or no inflation to speak of because of that. And governments kind of learned a lesson that they could print with impunity. You can print as much as you like, and all that happens is the stock market goes up, but the prices of things in the shops don't go up, or so it seemed to them. And then we went into the COVID epidemic, and governments once again went on a printing spree, giving people furlough payments. And in America, they sent out checks, dollar checks to everybody, every citizen, whether you were rich or poor. And there was an awful lot, there was a reduction in tax receipts. So once again, there was an awful lot of printing by the central bank as they bought up these government bonds. But what's been going on since then is governments have been unable to rein in their spending, and the debt is now increasing at an accelerated rate. So according to the official I'm looking at the United States now, but according to the official statistics brought out by the Bureau of Labor Statistics, the BLS, which brings out statistics based on the government's official budget for the future, we're going to see, for the first time in history, that level of debt as a percentage of GDP growing and growing and growing faster. What that means is the debt is going to grow faster than the income of the country grows, or faster than your salary, or basically faster than everything in the country. Now, the question is, how far can it go? Nobody really knows the answer. Some people cite Japan, where their debt to GDP ratio is well over 250. I think I saw a number saying 300% the other day, but I don't know what they were taking into account. And in America, it's well over 100%. But different countries are different things, and we don't know which way it would go. But if we go back to the 1980s in Europe, when Europe was being formed into the European Union, and we had the Maastricht Treaty, it was widely thought by economists that no country's debt to GDP should exceed 60%. Otherwise, we're in dangerous territory. And if it was an emerging country, it shouldn't exceed 40%. So it was written in the Maastricht Treaty in Europe, and hard written in the formation of Europe, that no country could become part of the EU or the European monetary system unless their debt to GDP was kept below 60%. So in Europe, we're on average about 100% debt to GDP. In America, we're 100% debt to GDP. In the UK, we're at 100% debt to GDP. Don't forget, at the Maastricht time, many of these countries were around 40% on average. UK was around 40, America was around 40, and Europe was around 40%. So we go from 40 to 100, and it is likely that that debt to GDP ratio will continue to increase, meaning that the governments are spending money faster than the economy expands.
Yeah,
so I'll stop.
To interrupt you. Yeah, I remember that. I mean, when they created the euro as well, I think it was 1998. Um, and then the banknotes only started, the changeover was actually in 2000, I think. I'm not sure, 2001.
Yep.
But there are three rules. I think the 60% debt to GDP, and also the 3%, the budget deficit could not go over 3% a year. And now we're running, the US is running 7% deficits. And Germany, up until the pandemic, their debt to GDP was below 60, and they were actually running surpluses, the Germans. But unfortunately, with what's happened because of COVID and the Ukraine war, Germany's gone out the window as well. And I think, yeah, so I'll let you continue.
So one of the problems that we have with rising debt to GDP is the rising level of interest, which has to be paid by the government on that debt. So as the level of debt itself, the absolute level of debt grows, so does the interest they have to pay. And if you think of it as if it was a household, and I know that governments are not households, but if you're in a household and your debt level increases, your interest is going to increase. Now, if your salary is going up, that's fine, as long as your salary is going up faster than your interest payments. But in the case of the United States, for sure, and probably in most of the rest of the Western and developed world, that debt is rising faster than their salary increases. That the salary increase in the case of a government is the tax receipts that they're getting. So the problem we've got is that as the debt rises and rises faster than the level of GDP, the interest payments on that debt are increasing. And there's another problem which is happening now. We've been through a long, long period, 15 years or so, since after 2008 through to 2 years ago, when interest rates were effectively zero and in some countries negative. So at that time, the governments were able to borrow through their bond market, through their treasury market. They could borrow at very low interest rates, let's say 1%, maximum 2%. A lot of that debt is now gradually coming to maturity. So the debt they borrow, when they borrow 5 years, 10 years, 15 years, 20 years, 25 years, 30 years. So as that debt starts to reach maturity, it has to be repaid. And because they can't repay it out of their tax receipts, they have to keep borrowing. They have to borrow the same amount, plus they have to borrow the interest, plus they have to borrow the new spending. But those borrowings are not at the old rate of 0.5%, 1%, 2%. Those new borrowings are at the new rate, which is in the United States, if you're looking at the short end, 5.25% to 5.5%. And if you're looking at the treasury market, anything from 4.25% to 4.5%, something like that, for the 10-year bond. So those interest rates on the new borrowings are effectively double the interest rate that the governments are paying on the old debt. So I think in the United States, the old debt is it's very approximate, about 2.3% across the board is what they're paying. But that number is gradually creeping up as old debt matures and has to be replaced by new debt at the higher rate, as does the new borrowing. They need to finance new spending, which is being financed at the higher rate. So the problem we've got in many countries is the level of interest is increasing much faster than the level of debt, if you like. So in the United States, a few years ago, we had the interest payments comprising about 8% of the tax receipts. It's now about 14% of tax receipts, and in about 3 or 4 years, it's going to be 30% of tax receipts. And if you step forward to sometime in the early 1930s, it's going to be 100% of the tax receipts. Now, obviously, that's a bit of speculation because it does depend on whether they bring any laws to raise taxes or lower spending or something like that in America. We don't know what's coming. But based on the present run rate, it looks like we're going to get to a situation where the interest alone will exceed the the totality of their tax receipts. So where's the money to spend on anything else? They borrow it, of course. They borrow it faster and faster. And that's a debt spiral. It's a bit like if you have a credit card and your outgoings on the credit card are getting more and more. You have to run around faster and faster from bank to bank, taking out new credit cards to pay off the old ones. And eventually the whole thing collapses because the banks lose confidence in you and say, we won't lend you any more.
And I think from what I remember reading about hyperinflation, and in particular in Germany during the Weimar Republic, I think that's when things started getting out of hand, when tax receipts could not cover the interest that the government owed on the debt. And what do? When that happens? Because investors, they're already fleeing from the treasury market, especially the BRICS countries. Well, I guess the solution will be for the Fed to step in and print, and that will be seen as really bad. And I think in terms of the fiscal policy that you said is uncertain, and it is, it looks like Trump wants to reinstate his tax cuts. And I'm not saying tax cuts are bad, but if you don't shrink the size of government, if you don't shrink government spending, it's going to be very difficult. And Clive, I wanted to show you this because this is quite relevant as well, because people just a lot of times only focus on the national debt, the government debt to GDP, but there's also the unfunded liabilities. And I saw this tweet here from, well, Frank Giustra, who's in the precious metals market. He retweeted what Rick Rule said here, and I'll read and see what you think. 80%, so 80% of the US population must confront the math. The net present value of unfunded entitlements at the federal level exceeds, well, it's such a big number, but it's $100 trillion. This number escalates by trillions annually. Meanwhile, demographics gets progressively worse. Where might the money come from? Well, that's a very good question. And I think short of defaulting on those entitlements, and I think it's going to be very hard for politicians to default on that because their voters are going to be very upset. So what do you think about that? What's the solution? I think this, well, I think I know what you're going to say.
I don't think America's going to default. That would be a last resort. But obviously, we will get effective default, possibly through inflation or possibly through some kind of restriction where you can't spend your money and destroy, or possibly another solution is where people are forced to hand over their bank deposits so they can invest in government bonds. I mean, whatever happens, we're going to get to a point where the can has to be kicked down the road in a way which is more serious than today. So the preferred solution by many politicians is that the Fed, if we get into a big problem, the Fed will bail out the Treasury by lending the government the money that the government can't raise from the public. But obviously, as long as the public are lining up to buy Treasury bonds, all well and good, because you can keep spending as long as someone will lend you the money. But the trouble comes when someone says, I don't want to lend you any more, or I don't want to lend you any more at the present interest rate. I want a higher interest rate to compensate me for the riskiness of what I'm lending you. And so when that point comes, and obviously at a certain interest rate, which might be 5%, might be 5.5%, I can't say where they draw the line. I'm talking about the 10-year bond rate. At a certain interest rate, it's going to be unacceptable. And the government's then going to turn to the Federal Reserve and say, please, would you buy these bonds from us? We want to borrow some money, please, would you buy it? And the Federal Reserve, the way it gets its money to buy those bonds is it prints it. So the reality in this world is when the government borrows money, the government gets poorer. It goes deeper and deeper into debt. So as the government goes deeper into debt, that's more money for somebody or everybody, but obviously not everybody, because it's only a preferred few who end up with the money as it filters its way through the system and upwards to the wealthy, the politicians, and the capitalists and the entrepreneurs. But as this money is printed by as it's borrowed by the government and then they spend it, someone's getting richer. So the rate of inflation, in my view, is the rate of increase of the government debt plus the increase in the money supply. And that's about 14% at the moment. But obviously prices are not going up by 14%. And the reason why prices aren't rising as fast as they print money, which would have been the case going back in history, but not these days, because all that extra money which is being created, all that extra wealth which is being created, is being used to fund the stock market, because the element which is linked to the amount of wealth on the planet in your inflation index is mostly the human labor element. Most things are made by robots. So if you buy yourself an item today, whether it be a food item or you buy yourself a lettuce, it's probably been grown in a factory and quite possibly almost untouched by human hands until it was put on the shelf. Likewise, you make a pizza, it was probably made by robots. So if you buy a pizza in the supermarket. So the reality is the human element is much less than it was 30 years ago, 50 years ago, 100 years ago, which means that whilst that the salary is going up, it's not as big a component of the cost. So the actual inflation rate on the items you're buying isn't rising that much. But where's that extra wealth going? Well, it's going to the gold price, it's going to stock market prices, it's going into the prices of property, it's going to the price of heirlooms and works of art, and basically anything that people want, who've got surplus wealth to save.
I agree partly with that about the inflation or the CPI, but I think a lot of it they're just hiding. I think people, the general public, is a lot, they don't believe in 3%, nor here in the UK in 2%. I saw a tweet the other day that in the 70s they calculated house prices into the CPI, but now they calculate renter owner's equivalent rent, which is a completely different thing. But Clive, I wanted to ask you, because that tweet said that the net present value of unfunded liability is 100 trillion. But here we've got Social Security liability, Medicare, and if you add them up, it's like 67 or 68 trillion. And then the total, what's this total here? Do you know what this is and how come they had only 100 trillion? Rick Rule.
I think when you just look at the rest of it, but obviously there's, as you say, there's 100 trillion of unfunded liabilities for Medicare and Social Security. But
About
where's the rest of it?
Trillion, yeah. There must be other things that they owe. Maybe, I'm not sure, but I think it's worse than the 100 trillion anyway. But I wanted to show
if it's 100 trillion, that's over 300% debt to GDP.
Yeah. The other thing I want to show you, Clive, is the M2 here from the Fed. Yeah, the balloons. I think this is what caused the rising prices, of course, during COVID. And then they've brought it down under control, but it seems to be rising already. And I spoke about this, I think, yesterday in my video, that apparently the Treasury is, they have an account with the Fed. And they had about 900 billion in April, and now it's down to 700 billion. So they've put it back in the system. So the M2 is growing again. And like you said, Clive, in this system of debt, you can't have money supply, which is the other side of the debt, shrink. They had to do it for a while here, but I think it looks like it's picking back up.
Yes, and we mustn't forget that whilst the traditional view of inflation, that's your view, my view, over most of the last 50 years has been one that the inflation rate is linked to the increase in the money supply. I think that's shifted somewhat now, and it's not the money supply itself, it's the money supply plus the level of debt. because, as I say, if the government gets poorer by borrowing more money, it's pushing that money that it's borrowed into the system, and of course, it might well find its way back into something else, but other investments. But at the end of the day, that's what's pushing up the wealth of the planet or the wealth of the country, as the wealthy people get richer due to the level of government debt increasing or the government getting poorer. So my view of inflation is, don't look just at M2, look at M2 plus the increase in government debt. So if we added the two together, you'd find that the curve upwards is accelerating upwards.
Yeah.
And of course, don't forget, when the government borrows money, that is a promise to issue it down the line. Whether if they're using T-bills, they're promising to issue the money or pay back the money in 3 months. If it's a note, it's in 2 years, and if it's a bond, it's in 10 years plus.
So what you're telling me is that it's even worse for people who look at the money supply like us, because they have to add the debt. But what is a bit not concerning, but I think they do this because they want to keep the game going, not just the government and the central banks, but Wall Street. They focus on these CPI, or even worse, they focus on what the Fed calls the PCE, the core PCE, which probably subtracts everything that goes up. But talking about that, Clive, it looks like today we're going to get those numbers. Let's show you here. There you go. This is what the market is going to look at today. Core PCE is expected to drop from 2.8% to 2.6. If that number were to drop to like 2.4 today, I think that would be very bullish for everything, but it's not telling the truth. Like Clive said, he thinks the rate of inflation, Clive, like you said, that makes people poorer, is really the debasement of the currency. And maybe with that, we could switch to why gold and silver are so important in this case.
Sure. While you were talking just there, Mario, I brought up the amount of interest which is being paid by the government on its national debt. In 2021, the interest was costing them on everything they'd borrowed 1.57%, and the amount they had to pay was 352 billion. In 2023, that's 2 years later, that interest rate had risen to 2.5%. That's not the rate of interest on the new debt. That's the rate on all of their debt, old and new. So effectively, the rate of interest was nearly double, and the amount they were paying on their national debt had almost doubled, from 352 billion to 658 billion in just 2 years. So that's the current year, almost double what it was 2 years ago. And if we look forward at the Bureau of Labour Statistics own number for 2025, I see that they are forecasting that the interest rate will be 3.3% on the totality of debt, and that the interest payment will almost double again. It'll be over 1 billion of interest. So that the amount of interest the government is paying is increasing very, very rapidly. And of course, that will have an impact on the gold price, which we're now going to talk about.
Yeah, I think you meant 1 trillion there.
Yes, I meant 1,000 billion.
I know. All these zeros make it really confusing, and
Yes.
I saw that there are some socialist economists who want to have a wealth tax on billionaires. But my view is that if we hadn't had all this money printing, the word billionaire wouldn't be used so commonly as it is today. But yeah, let's look at gold. And Clive, the other thing I wanted to touch upon, and this is also dangerous for the treasury market in the US, is that the yen continues to drop to new, like, multi-decade lows. Like this morning, the dollar is traded above 161 versus the yen.
No. Oh
Yeah.
my God.
Yeah, we're now
So
at,
they were saying some months ago, we were talking about it on this show, that the danger level for the yen was when it got to 160. Well, it's broken through that well and truly. And then we started talking about a danger level of 160, and we're above that now.
Yeah, and I think, like you said last week, I think we spoke about the yen, that a lot of even while the Bank of Japan, how do they intervene? And I think they've already used 60 to 80 billion this year to intervene, and it hasn't worked. While they will sell their treasury holdings to cash in the dollars, and then they sell the dollar and buy the yen. That's how it works. So that's not going to
So
help.
yeah, so let's just look at what's been going on in the recent past. Over the last few years, interest rates have been rising. They've come from, in America, they've come from 0% to 5.25%, 5.5%. Rising interest rates are, or used to be thought to be bad for gold, the gold price, but in fact, the gold price in the same period that from when interest rates started rising to now has more than doubled. So the gold price has been going up despite rising interest rates. We've also seen in the last 2 years a fall in the rate of inflation from something like 6.5 to 3.5 now. The gold price has been rising despite the headline number of the CPI, or the rate of increase of the CPI falling. So we have the rate of inflation falling, not as high as it was, which should be a negative for gold, but gold price has been rising. We've seen more recently, in the last year or so, the dollar rise that's risen against most currencies. It's been one of the strongest currencies. The dollar index has risen quite substantially. It's risen from about 98 to 105 or 104. So despite the rise in the dollar, which is normally bad for gold price, the gold price has been rising. And lastly, we saw in the month of May that the government of China, who was a major buyer of gold, the government of China did not buy any gold in the month of May for the first time in some 18 months, which should have been negative for gold. Yet in the month of May, gold hit multiple all-time record highs. So the gold price has been going up despite all these possible negatives. What will happen if the Federal Reserve lowers interest rates? What will happen if, because of the lower interest rates, the dollar starts to fall in value on the international exchanges? What will happen if China has resumed or does resume its gold buy? We don't know. We'll know in about a couple of weeks whether they bought any in June. What will happen if the rate of inflation start to pick up, as I think it will? I think in 2025, whilst we're probably heading on the official number lower through to the end of the year and maybe early next year, what will happen if after the beginning of next year, the rate of inflation starts to pick up? In other words, all these things which have normally been negatives for gold start to turn positive for gold. Well, I think the most likely scenario is that gold will move ahead at a faster rate than we've been seeing at the present time, which makes gold quite an attractive purchase for me. And I'm not giving investment advice to people. I'm not saying put all your money in gold, but certainly I think it's a good idea to have some. And I think it will be a nice piece of insurance if everything else falls apart. And I'm going to talk about one other thing which might be good for gold in a second. So it's kind of an insurance, which is actually an insurance which will probably have a very good performance going forwards. And the last thing I wanted to talk about, which could affect gold, we've seen a very high-flying stock market, and all of that growth has been driven in the large cap, the mega cap stocks. So if you look at a chart of mega caps in the United States versus the Russell 2000. The Russell 2000 index is an index of small to mid cap companies outside of the mega caps. You will see that over the last 18 months or so, the mega caps have just taken off like a rocket, whereas the mid caps and small caps have basically stayed where they are. They've hardly moved. So there's a valuation gap grown between the two, and the result of that is the mainstream indices like the S&P 500 or the World Equity Index have all benefited from this huge rise in the mega cap index. Now, what does that mean? If those mega caps at some point pop and trust me, they always do at some point. And that's not a prediction that it's next week or next month or next year. Don't forget, a bull market can carry on far longer than you expect. But at some point, it always pops. When it does, it's going to make the mainstream indices like the S&P 500 start to go lower. And when that happens, investment managers are going to rein in their forecasts and start to look around for another asset class. And I think that at that time would be quite positive for gold because the allocation to gold will be increasing. I've seen personally 2 banks write to me in the last 10 days advising that we should increase gold holdings as a protection, portfolio protection against what they call volatility. Now, you've got to know that when a firm or a bank says the word volatility, and you'll see they say that most years, what that means is they fear prices will drop. Of course, that's not the proper meaning of volatility. Volatility means prices go up, they go down, they go up, they go down. But when people say you need some protection against volatility, they're really saying you need protection to the downside when stock markets go down. So if you see from your bank or from your investment manager that he's forecasting volatility ahead, read between the lines and read that he's forecasting that stock prices might go down. And in that case, you need to be doing something else. And I wouldn't advise going with his suggestion of, if he makes a suggestion of buying more bonds, I would buy more gold. That's the way I would go.
I agree, especially with what's going on fiscally and with interest rates and inflation. Just a last comment here, Clive, before we wrap up. Even Goldman Sachs now, their research is saying gold emerged as the best commodity to serve as a potential hedge against inflation and geopolitical risks. Goldman Sachs research base case is that gold appreciates to 2,700 troy ounce by year end. And I have to say, that's unusual for Goldman Sachs and the big banks. They're usually very conservative about gold and their predictions.
I've seen another bank, one of the largest investment banks in the world, predicting $2,700 as well. It's UBS. So yes, I think the tide is turning in terms of portfolio managers starting to accept that they should have more than zero gold in the portfolio. I think the number will, whatever number they have at the moment, whether it be 1%, 2%, or 3%, I think that's going to go up. And I could easily see us finishing the year with a recommendation to have 5% gold, and probably down the line it will move upwards to the more like 10 or 15% down going forwards in a few years.
Well, yes, that will be, it doesn't sound a lot like 10, even 5%, but when you realize that it's coming from zero or a very low proportion, it will be huge for gold. And I think silver will follow too.
Yes, I mean, silver's got different dynamics, but I think the supply and demand dynamics, which we have talked about on this show, i.e. falling mine production and rising demand from photovoltaic and rising demand from the electronics industry, particularly due to data centers, which are springing up all over the world now and basically need the most perfect electricity connectors, which is silver, to make sure that everything runs at the fastest possible speed. I think that's we saw very, very large increases in the demand for silver last year from those two parts. I think the photovoltaic, it was up about, according to the World Gold Council, up about not the World, the Silver Council, Silver Institute, was up about 40-something%, and the demand for electronics industry was up about 20-something, like 20%, and that's set to continue. Increasing the gap between mine supply and industrial use, which is already in favor of industrial use. There's much more being used than they can get out of the ground. So the difference is coming from recycling. But to get that recycled silver, the price has to go higher.
Great. I agree. And I'm going to keep stacking as much as possible if I have extra fiat currency reserves in my bank account. And Clive, just want to tell the viewers as well, if you want to connect with Clive, you can do it through LinkedIn. Clive, send him a a request, Clive Thompson, and he'd be happy to connect with you and discuss stuff with you. It's not a place just for chit chat, I would say, though, Clive. And with that, I want to wish you a great weekend.
Thank you very much, Mario. Thank you very much to all your listeners. Let's wait and see if in a few weeks whether China has resumed its buying of gold. It still has less gold than Russia, France, Italy, IMF, and Germany, and of course the United States. So it's got a long way to go to catch up with other Western countries.
Yeah, and that's official, though. Some people speculate they've got a lot more. But anyway,
Yeah, we know they could be lying. They could have a lot more, but what's the motivation for doing that? I wonder.
maybe to keep the price from rising too quickly
Yeah.
because they want to buy
Oh,
more.
yeah, there could be some motivations. Of course, there's a lot of gold in the hands of the Chinese citizens and Chinese mines as well, which one might regard as part of China's gold reserves. So we don't really know the true amount of gold they have, but officially, according to the numbers that they publish every month, it's still not quite as much as their neighbor Russia or Italy, Germany, and the United
Yeah,
States.
I agree. I agree with you. So there's a lot of potential still for them to buy more. Anyway, thank you, Clive, and take care.
Thanks very much, Mario.